Hi! Welcome to MBH Online Accounting and Business Solutions YouTube channel. I'm guessing you are here watching this video right now to learn more about bookkeeping. Before you go further into this video, please make sure you've watched the previous regarding Bookkeeping 1, Golden Rules of Accounting, because we will be focusing the bookkeeping for merchandising in this video. To begin, here are the topics that we will mainly discuss throughout this video. What is merchandising? Types of merchandising companies, merchandise inventory versus cost of goods sold, approach used for merchandising inventory, and methods used for cost of goods sold. Bookkeeping is the process of keeping track of all the company's financial transactions. Every financial transaction that occurs during the course of business operations is recorded, classified, and organized by bookkeepers. So what is merchandising? According to Google, it is the activity of promoting the sale of goods, especially by their presentation in retail outlets. Under the business term, it refers to the marketing and sales of products, which may refer to the marketing, promotion, and advertising of products intended for retail sale. There are two types of merchandising companies. The wholesalers, they purchase vast quantities of merchandise from a variety of manufacturers and then resell it to a variety of retailers. And retailers, they are companies that sell items or merchandise directly to the general public. Here are some terms that you need to know. The cost of goods on hand and available for sale at any given time is known as merchandise inventory. Merchandise inventory, or just inventory, is a current asset with a normal debit balance, which means that the debit will increase as the credit decreases. Cost of goods sold is the cost incurred by a firm in the production of a product or the purchase of inventories. During the period of sale, inventory that has been sold becomes an expense, which is accounted as cost of goods sold. What are the activities or approaches used for merchandising inventory? First is the operating cycle. Operating cycle of merchandising pertains to the series of transactions that the company uses to generate revenue and cash from customers. Start with cash. Purchase of merchandise would be the inventory. Sale of merchandise. Collection of accounts receivable if sold on account, or the collection from customer, then back to cash. Next is the income statement with the formula of sales less cost of goods sold is equals to the gross profit less other expenses would be the net income. Remember, when preparing a merchandising company's income statement, it is important to break costs into product and period cost. Always calculate gross profit, which is the sales less cost of goods sold. Period cost can be referred to as operating expenses, selling and administrative expenses, or both. Perpetual system. All transactions including the cost of merchandise are promptly recorded and the record is always up to date. Let's see the example here. On January 20, the company had a transaction of sale for 10,000 pesos, with the cost amounting to 6,000 pesos. Our entry would be debit cash for 10,000 and credit sales for 10,000. Here's an important note that you need to consider. If you work for a company that uses a perpetual inventory system, the cost of goods sold has already been calculated. Hence, we will be recording an entry for that. Debit cost of goods sold for 6,000 and credit merchandise inventory for 6,000. Next, on January 28, a purchase amounting to 5,000 pesos. Our entry would be debit merchandise inventory for 5,000 and credit accounts payable for 5,000 if was purchased on account. If not, credit would be cash. Next is the periodic system. It keeps track of all inventory purchase transactions in separate accounts and only records the cost of goods sold at the end of the quarter. In this system, there is no attempt to maintain records up to date. The beginning and ending inventory are physically counted over a period of time. The company will also account for total purchase made for inventory in that period to find out cost of goods available for sale, where cost of goods available for sale equals beginning inventory plus purchases. So cost of goods sold for that period will be cost of goods sold is equal to cost of goods available for sale less ending inventory. To sum up, the total of the beginning inventory and purchases during the period represents all goods that the firm had available for sale. After subtracting the ending inventory from this total, the remaining balance represents the cost of the items sold. Example with same given transactions from the previous one. Our entry would be debit cash for 10,000 and credit sales for 10,000 pesos. In here, we won't be having an entry for cost of goods sold. Next, purchase for 5,000 pesos. Entry would be debit purchase account for 5,000 and credit accounts payable for 5,000 if on account. If not, credit would be cash. Note that no merchandise inventory account entries are made during this time period. The balance in the merchandise inventory account will reflect the amount of inventory at the start of the year before any adjusting entries.
To continue, let's now discuss the inventories and cost of goods sold. First, let's define what is inventory. Inventory is a key current asset for retailers, distributors, and manufacturers. Inventory consists of goods, products, merchandise waiting to be sold to customers as well as manufacturers, raw materials, and work in process that will become finished goods. Inventory is recorded and reported on a company's balance sheet at its cost. When an inventory item is sold, the item's cost is removed from inventory, and the cost is reported on the company's income statement as the cost of goods sold. Cost of goods sold is likely the largest expense reported on the income statement. When the cost of goods sold is subtracted from sales, the remainder is the company's gross profit. There are 4 methods used for cost of goods sold. First is the specific identification. Second is the average cost. Third is the FIFO or first in first out. And lastly is the LIFO or last in first out. The specific identification inventory valuation method is a system for tracking every single item in an inventory individually from the time it enters the inventory until the time it leaves it. Average cost is a cost accounting term that is sometimes referred to as unit cost or weighted average cost. Average cost can refer to either average cost of inventory or the average cost of units produced. First in, first out or FIFO is an accounting method in which assets purchased or acquired first are disposed of first. Last in, first out or LIFO is an accounting method in which assets purchased or acquired last are disposed of first. Under the perpetual inventory method, it calculates cost of goods sold for each sale and records a journal entry for cost of goods sold with each sales transaction. Under the periodic inventory method, it follows the same basic principle but it calculates one cost of goods sold amount at the end of the month for all items based on the beginning inventory plus all purchases and does not record cost of goods sold with each sales transaction. Now, take a look for a specific identification example. A company bought 7 units of goods in which 3 at 300 pesos and 4 at 400 pesos, and sold 3 units which costed 1 at 300 pesos and 2 at 400 pesos. If beginning inventory is 0, then Goods available for sale is equal to 3 multiplied by 300 pesos equal to 900 pesos plus 4 multiplied by 400 pesos equal to 1,600 pesos for a total of 2,500 pesos. Since we sold 3 units which costed 1 at 300 pesos and 2 at 400 pesos, then the goods on hand is equal to 2 multiplied by 300 pesos equal to 600 pesos plus 2 multiplied by 400 pesos equal to 800 pesos for a total of 1,400 pesos. For the calculation in perpetual inventory method, we will use the 3 units sold which costed 1 at 300 pesos and 2 at 400 pesos. So the cost of goods sold is equal to 300 pesos plus 800 pesos for a total of 1,100 pesos. While for the periodic inventory method, we will use the total goods available for sale which is 2,500 pesos minus the total goods on hand costed 1,400 pesos for a total of 1,100 pesos cost of goods sold. As you can see on the example, we use different methods but the outcome is just the same. The next example is for average cost. A company bought 5 identical generators at 2 different rates. 2 at 2,000 pesos per unit on March 10, 2020, 3 at 2,200 pesos per unit on May 9, 2020. Therefore, the generators in inventory acquired at a total cost of 2 multiplied by 2,000 pesos is equal to 4,000 pesos plus 3 multiplied by 2,200 pesos is equal to 6,600 pesos for a total of 10,600 pesos. Thus, the average cost of each generator is 10,600 pesos divided by 5 identical generators for a total of 2,120 pesos. The company sold the generator at 3,600 pesos on June 1, 2020. Let the beginning entry level of inventory is 0, and interim period of company is semi-annually starting from January. So the entry for purchases in perpetual inventory system would be on March 10, 2020, debit 4,000 inventory and credit 4,000 cash. While for May 9, 2020, debit 6,600 inventory and credit 6,600 cash. Next, for the entry for sales in perpetual inventory system would be on June 1, 2020, debit 3,600 cash and credit 3,600 revenue or sale. Then debit 2,120 cost of goods sold and credit 2,120 inventory. Here's the summary table for our example in average cost. On March 10, 2020, we purchased 2 units at 2,000 pesos for a total of 4,000 pesos. On May 9, 2020, we purchased another 3 units at 2,200 pesos for a total of 6,600 pesos, so our balance would be 5 units at 2,120 pesos for a total of 10,600 pesos. And on June 1, 2020, we sold 1 unit at 2,120 pesos for a total of 2,100 pesos, so our balance for June 1 would be 4 units at 2,120 pesos for a total of 8,480 pesos. In periodic inventory system, the calculation would be cost of goods sold is equal to goods available for sale minus cost of goods on hand. So cost of goods on hand is equal to average cost, which is 2,120 pesos times the remaining units goods of 4 for a total of 8,480 pesos. Cost of goods sold is equal to 10,600 pesos minus 8,480 pesos for a total of 2,120 pesos. For FIFO and LIFO, we will use the same example in average cost. A company bought 5 identical generators at 2 different rates. 2 at 2,000 pesos per unit on March 10, 2020. 3 at 2,200 pesos per unit on May 9, 2020. Therefore, the generators in inventory acquired at a total cost of 2 multiplied by 2,000 pesos is equal to 4,000 pesos plus 3 multiplied by 2,200 pesos is equal to 6,600 pesos for a total of 10,600 pesos. Thus, the average cost of each generator is 10,600 pesos divided by 5 identical generators for a total of 2,120 pesos. The companies sold a generator at 3,600 pesos on June 1, 2020. Let the beginning entry level of inventory is 0 and interim period of company is semi-annually starting from January. In FIFO, we will assume generator which was sold was from purchase of March 10, 2020. So the entry of cost of goods sold will be debit 2,000 cost of goods sold and credit 2,000 inventory. The table shows on March 10, 2020, we purchased 2 units at 2,000 pesos for a total of 4,000 pesos. On May 9, 2020, we purchased another 3 units at 2,200 pesos for a total of 6,600 pesos, so our balance would be 5 units. 2 units at 2,000 pesos plus 3 units at 2,200 pesos for a total of 10,600 pesos. And on June 1, 2020, we sold 1 unit at 2,000 pesos for a total of 2,000 pesos, so our balance for June 1 would be 4 units. 1 at 2,000 plus 3 at 2,200 for a total of 8,600 pesos. In LIFO, we will assume generator which was sold was from purchase of May 9, 2020. So the entry of cost of goods sold will be debit 2,200 cost of goods sold and credit 2,200 inventory. The table shows on March 10, 2020, we purchased 2 units at 2,000 pesos for a total of 4,000 pesos. On May 9, 2020, we purchased another 3 units at 2,200 pesos for a total of 6,600 pesos, so our balance would be 5 units. 2 units at 2,000 pesos plus 3 units at 2,200 pesos for a total of 10,600 pesos. And on June 1, 2020, we sold 1 unit at 2,200 pesos for a total of 2,200 pesos, so our balance for June 1 would be 4 units. 2 at 2,000 pesos plus 2 at 2,200 pesos for a total of 8,400 pesos. And that's it. I hope this video was helpful for you to get familiar with the core principles to merchandising. Thank you for watching. See you in the next video.